All right, looks like we just hit the noon mark. So, for the sake of time, we'll go ahead and get kicked off. Happy New Year, everyone. Thanks for joining us today. On behalf of your Baird financial advisor, I'm excited to welcome you to the first Baird Wealth Strategies webinar of 2025. Very grateful, very excited to be joined by PWM market strategist Mike Antonelli and investment strategist Ross Mayfield as they discuss what you need to know to invest in 2025. Today, they're going to cover the key things they're watching in the stock market, how changes to tariff and immigration policy might impact the economic outlook, and what investors need to know after back-to-back years of 20+% in the stock market. So before I turn the call over to them, just a few housekeeping notes to highlight. One, for optimal viewing, we suggest setting your layout in the side-by-side view via the circle in the upper right corner of your screen. All participants are in listen-only mode, but we would love to hear from you. We're going to host a Q&A session at the end of the call to address as many questions as time permits. You can submit a question by clicking the Q&A icon. It should be in the bottom right-hand corner of your screen. Please just be sure to address your questions to all panelists. That way, Mike, Ross, and I can all see those. Lastly, this presentation is being recorded and will be available along with the slide deck through your Baird financial advisor about a week following today's call. So with that, I think we're good to go. So again, thank you for joining us today. I'll turn the call over to you, Mike. Floor is yours.
Awesome. Thanks so much. We appreciate everybody not only watching live. I know it's a lot to just midday pop onto a call talking about the markets and investing and potentially some new changes in the administration. But if you're watching later, if you're at home, you've caught this on your advisor's email, your advisor's website. We'd also like to join you. I have my friend Ross Mayfield with me. Ross, you ready to go? You ready to do this?
Yeah, let's do it.
Yeah, we have an interesting little deck for you today. We're going to shoot for really short. One of our goals, I think, in 2025 is to do shorter events. I mean, we can get this information across to you as quickly as possible so you can move on with your day. And you know what? Nobody ever said I wish something was longer when it comes to market-related events. So we're going to aim for about 30 minutes here. My friend Ross put this picture in to kick off our 2025 event, Onward and Upward, showing that great building in Louisville. Ross, I can't wait to come back to Louisville. Seeing Baird's name on the building is great.
Come on down.
Yeah, absolutely great. So nice image of our Louisville branch. Our disclosures, we're going to kick off our disclosures here just to satisfy all the requirements to do live events for customers and clients in the proper way here. So we are going to do a couple different things, okay? We're going to start essentially talking a little bit about perspective, because I have found in my life that as I get older, perspective is important. You need to stop and say, where have I come from? What has happened? I need to take stock in what I've accomplished, what others have accomplished, what the market has done. And Ross and I have a pretty cool way to talk about this. What we're going to do is we're going to talk a little bit about the 80s and 90s, and then we'll talk about the 2000s and 2010s and 2020s after that, just to, again, give us some perspective. But before we do that, we want to make sure you're getting all of our content. All That Matters, this series that Ross and I do once a month. We've been doing it for 2 years now. And if you have been following along with us, and there are a great many of you that have, if you've been following along with us, the commentary we've put out, the kind of content, especially around elections, really helped a lot of our customers. A lot. We had some really solid commentary over the past 2 years. We have been telling you exactly what matters. And we've been telling people that the market isn't as scary as they're seen in the headlines over the past few years. So make sure you're following us on All That Matters. Coming to our live events, I go on the road a lot. Ross goes on the road a lot. So make sure that you're following us along in person and on All That Matters. We will have a new episode coming out at the end of this week, and I know you're going to want to watch it. It's got a really good one. It'll be some of the commentary you're hearing today, but I know you're going to want to watch it. Ask your advisor. If you're not seeing this, ask your advisor to send it to you today, okay? Today. Let's kick off with perspective. So Ross, I was born in the 70s. So I was a kid in the 80s, and I became a young adult in the 90s. The stock market from the 80s to the 90s, a lot of our clients on this call will know, a lot of the baby boomers and even the Gen Xers like me will know that this is the #1 bull market of all time. The 1980s and the 1990s combined was an incredible 20-year period for the stock market. The 1980s kicked off about a 70% annualized return, and the 1990s was even better, okay? At the end of the 80s, I bet people were saying, gosh, what a great decade for the stock market that was. There's no way it will be better No way it'll be better in the 90s, and the 90s were actually better. Ross, what's the perspective as we advance the slide here to what's happening now?
Yeah, I think it's a great way to frame up the last 15 or so years, because as that headline that we had copied from the Washington Post on the previous slide, a lot of people at the end of a great run are skeptical that it can continue, right? I don't know if it's our inherent negativity bias or how it operates, but we always are kind of like looking around the corner for the next big bad, boogeyman to knock the market down. And so after a run like the 80s, which to that point was probably one of the best decades in the history of the stock market, at 17.5% a clip, people were probably ready to pull chips off the table.
Yep.
I think that entering 2020, people probably felt the same way. 14-ish% annually across the 2010s. Big cap, mega cap tech stocks leading the way, doing great. Just a really tremendous bull market. And so as we turn the page, I think the question is, can this keep going? Does that strength mean that the future returns have to be bad? If you've paid attention to this, you've heard a lot of doomer calls for a lost decade, for lower returns into perpetuity because of valuations or whatever. Look at what happened in the 90s. The strength of the 80s did not impact the market from going on into the 90s, doing even better, the internet boom, everything we know about now with perfect hindsight. Looking to the 2020s, we're seeing the same thing so far, a better annual return through the first 5 years. Mike, put that in perspective for us. I mean, even if the next 5 years were mediocre, right?
Yeah, I have a couple great stats that I saw this morning, Ross, that I wanted to put on this call for our customers. So less than 5 years ago, we just got to say, when we say the stock market, okay, Ross and I have to use this generic term stock market because there's no other real way for us to talk about essentially what's happening in the world, right? So when we say stock market, what we say is the S&P 500, which is the 500 biggest companies in the United States. That probably doesn't match your returns. Advisors all the time say, well, my clients aren't 100% in the S&P 500, which makes sense. Nobody really is. But it's the only way we can talk about the stock market as a whole. It's just what we use is the S&P 500. So less than 5 years ago, this index was at 2,900. It's now at 5,950. In 2012, it was at 1,450. In 2009, it was at 725. So essentially, over the last 16 years, the stock market has doubled 3 different times. 3 times the stock market has doubled in 15 years. And this is despite every negative event that you could ever have talked about or heard about or read in the news. The stock market continues to do well. It actually has doing so well in the 2020s, to Ross's point, the last essentially 5 years, right? So 2020, 21, 22, 23, 24. It's done so well that even if we got subpar returns for the rest of this decade, it would just be a normal decade. That's just how well it's doing. So when I say perspective, I want you to pull a statement from 8 years ago, pull a statement from 5 years ago, pull a statement from 10 years ago, see how far you've come. You have to do that along the way to really acknowledge what's been happening. And Ross, the last 5 years, talk a little bit about what you and I do on a daily basis, even while the stock market does what it's doing.
Yeah. So, I mean, this is the last 5 years have been just like the perfect summation of everything that we talk about, that we build our decks around, that we build our careers around, which is the idea that the market does well despite all of the calamities in the world, all of the headline noise that you're faced with, right? So entering 2023, calls for recession at every corner. 2022, we had rising interest rates, high inflation. Everybody was calling for a recession in 2023. Instead, the market's up 26%, the economy expands. Entering 2024, like you see on the screen, election year volatility, geopolitical instability, all of the things that you're beaten over the head with day in and day out. And yet the market does another 25%. Mike and I, the screen grab from our election All That Matters in March 2024, we said, historically election years are strong for the market. And yet if you turned on the news or, open social media, that promise of persistent volatility is enough to scare anyone out of the market if it catches you on the wrong day. Our goal is to push back against that. And I want to say one more thing before I turn it over to Mike. So I think in media, there's an idea that, the perfect media is like balanced, right? Some good, some bad, a perfect balance. They try to be net neutral. I actually think it probably skews negative. If it bleeds, it leads. But the market is the opposite, right? The average market return over the last 100 years is like 10, 11% a year. So what should we expect from the market? We should expect it to go up over time as profits grow. That is the assumption built into all of your portfolios. It will be pockmarked with recessions and volatility and bear markets along the way. That's almost also guaranteed. But we know that the market has gone up over time despite all these headlines and negative news. And the last 5 years are like the perfect example of that. COVID-19, Russia invades Ukraine, elections. I mean, I couldn't even sit here and count all of the things if I had the full hour, but that is essentially what we're battling against day in and day out, and what you as investors kind of have to deal with to reach those long-term goals that you plan for.
So one of the unique things that Ross and I do, and I think Baird in general, okay, is that we spend a large amount of time as strategists and analysts and thinking about you, we spend a large amount of time myth busting. Like we spend an inordinate amount of time on All That Matters, especially pushing back against things that will knock you off your plan. Other firms, they just spend their time just dumping information into the world. They just dump data, they dump charts. Ross and I, Baird, our partners at Strategas, we spend a lot of time trying to keep you on track and to try to dispel things that will knock you off. Ross and I spent literally like 6 months talking about trying to talk people out of the decline of the dollar or a central bank digital currency or the national debt. We spent months doing that. Right now, the US dollar is at one of its highest levels in decades. But yet we spent months talking to people about the decline and demise of the dollar. So when you come to engage with our content, when you come to your advisor, when you come to Baird, we're trying to break through this noise, and it's only going to get worse. The next 5 years will only get worse. But here we're going to do things differently for you. And if you listen to us over the past few years, the stock market's up 65% in 2 years. That's incredible. Absolutely incredible amongst all the noise of the world, okay? Ross had this great chart about the last 5 years. The S&P, these are annualized numbers, okay? It's not total, it's annualized. The S&P 500, like we mentioned, annualizing at 15%, a really, really good last 5 years. A 60-40, which is your standard run-of-the-mill wealth management traditional portfolio, 60 stocks, 40 bonds, is up about 9%. But bonds, Ross, bonds are flat, right? What's going on with bonds? What's your take there?
Yeah, I mean, we saw inflation spike to the highest levels since the early 80s. Interest rates rose as a result. Off of 0%. I mean, if you've been a saver for the last decade, you know that interest rates are at zero, and that hurts the price of bonds, right? As rates go up, the price of bonds out on the market falls. The thing that jumps out to me here is that even a relatively, conservative-ish wealth management portfolio like the 60-40, in one of the worst 5-year stretches for bonds in the history of bonds, is up about 9% a year, right? You've turned $100 into $150. Over the last 5 years, despite two huge bear markets, despite a recession, a pandemic,
bonds doing nothing,
despite bonds doing nothing, right? That is usually not going to be the case. I mean, today bonds are yielding, 4 or 5% on really high quality treasuries. So that's not going to be the case going forward. But despite it having one of the worst half decades for bonds in the history of bond market, a wealth management portfolio has allowed people to reach goals, has beaten inflation, has done exactly what we would want it to do in an environment like we were in.
Yeah. So one of the questions, I'm just going to, as we go along, there was a good question that kind of popped in about if you took the Mag 7 stocks out of the index, what do your graphs look like? There's two. I think there's two ways to approach that. Number one is they're part of the index. Okay, taking them out is like saying I want to take out the best parts of dinner. What would dinner look like, right? I mean, they are part of the index. They're the biggest, most profitable companies in the world. So to take them out is to say you're taking out American ingenuity and an incredible innovation and stuff like that. And number two, Ross and I often look at what are called equal weight charts, which means you try to take the effect of these giant ones and just equally weight the whole index. Last year, all sorts of equal weight index made new all-time highs. The equal weighted S&P, equal weighted industrials, equal weighted, all these things did make new all-time highs last year. So do they have an impact on the market? Yes, but that's just how the world works. They're so important and so big and so profitable that yes, they have an impact on the market, but you get to benefit from that. You get to invest in them just alongside everybody else. Do they have an outside impact? Yes. Okay, we're kind of halfway through here, so let me
really quickly
to the new administration. We want to talk a little bit about. Wait, go ahead, Ross.
Yeah, sorry. Equal weight S&P up over 50% in the last 5 years. So certainly not the S&P, but perfectly fine. That's a great 5 years, especially given all that's happened. So just wanted to put that out there to answer the question as directly as
well. In fact, Ross and I have done all sorts of studies on big companies and their impacts on the index. If you were to go globally, if you were to look at other nations, okay, like just other indices, they suffer from worse. Their biggest weights are way more than ours are, which is, people don't talk about that quite often. But if you go into other nations in Europe or Asia, their top 10 are way bigger than our top 10 in terms of its impact on the index. So, all right, so we're going to move on. We have a new administration coming up. I know there's a lot of questions about the new administration. We're going to try to tackle a few of them here. Of course, we'll tackle them along the way as things come up, right? And we have 5 days to the inauguration. But Ross, you came up with this great slide. Why don't you walk us through this one?
Yeah, I think it builds on what we talked about. So 2023, people calling for recession, markets up. 2024, election year volatility, markets up. 2025, we don't know what the market is going to do, but I can already tell you what the headlines are saying, which is that new administration volatility could be a weight on the market, right? The uncertainty associated with all of the policy proposals. And what I would say to that is, I don't know whether the market will be up at the end of the year or not, but if we look at history and try to be as evidence-based as possible, we can see that these are the first year of a presidential cycle back to World War II, right? So every president's first calendar year, including President Trump's first year, 2017, where the market was up over 20% and only fell, I think, like 3% entry year, one of the calmest years in market history. But what we can see is just that, yes, new administrations bring headline volatility, policy change, and what the market does typically is not react. Look through it. The last 10 of these, the market's been up in 9 of them. Since World War II, the median return is 15%. So there might be more headline volatility, but I can tell you right now that over history, the market has not necessarily cared about that volatility as a driver of returns.
Yeah, I mean, look at this. So just look at recent history. So 1985 to now, there's only one down first presidential term year, and that was 2001. We all know what happened at the end of 2001, right? This is Bush's first term. Then we had a terrorist attack. It really exacerbated the recession the United States was having. So, but all the other first years, all the way back to Reagan's second term, have all been positive. Again, we're not saying this is guaranteed. Nothing we ever say is guaranteed. What we're trying to do is say, what is the evidence of history? Why are presidential terms so good? Why are the first ones so good? Well, there's excitement about a new policy proposals. There's excitement about change. So when you look at something like this, the goal isn't like, oh, what if this is the 60s? What if this is the 70s? The goal is to say, in recent history, look at how well the market has reacted to the first presidential term, including like what Ross said, which is Trump's first term, which was one of the best years in history. 2017 was one of the best stock market years in history. I remember trading through that one, Ross. It had a 2.8% decline the whole year. It's just absolutely stunning. But what is the flip side of all this? Okay, what is the flip side of presidential terms? Now, if you saw me live, or if you watched our All That Matters on elections, you are going to recognize this chart, which I featured constantly. And it was mainly to remind people that the world, history, happens to the person sitting in Pennsylvania Avenue. Every president, back to Herbert Hoover, at some point during their presidency had a bear market, all of them. Why? Was it something they did? No, the world broke. Something happened somewhere. In fact, in my live events, I went through a few of these and said, you know, Reagan got the crash of '87. Donald Trump got COVID. George Bush got 9/11 and the GFC. Biden got the inflation spike. Every president had a bear market, Ross.
Yeah, absolutely. And like you said, and I won't belabor it, but it's the economic environment. It's what's happening in the world, and the president is the figurehead. And that's going to be the case, whether it's a Democrat or a Republican or a third party candidate. It's going to be the case in the US or some other country. The global economy is much, much, much bigger than the person who sits in the White House.
Yeah. And I said in my live event, I'm like, I think it's safe to assume that there will be a bear market sometime over the next 4 years. Why is it safe to assume that? Why am I saying that? I'm just looking at this history. I'm looking at this chart. I'm looking at the history of the United States and its stock market and saying, if every president back to Hoover had a bear market at some point, why would it be different for the new one, right? What would be different for the current one? And again, this is not because of them. It's because the world is a chaotic place. The stuff that happens to them happens out of the blue. That's generally what knocks the US economy down or knocks the stock market down. Something that happened out of the blue. Here's an example before we move on. The 3 most important events of the last 25 years were 9/11, the global financial crisis, and COVID. Those were the three most crucial, critical threats to the US stock market. And none of those were predicted. Nobody ever started 2020 and said we were going to have a pandemic. History happens to the president. You have to remember that. Donald Trump, our new president, will have to deal with the world. We have to deal with history as it evolves. So speaking of our new president, there's something that Ross and I have thought about a lot because we've seen it in our past. So when President Trump's first administration was in power from 2017 to the end of 2020, I noticed something called the Trump market cycle. And this was when I was a trader. I wasn't probably wealth. I was a market trader. President Trump likes to make policy or likes to push proposals out on social media. He does. He likes to say, this is what I'm going to do. This is what I'm thinking. It comes out on social media. So much so that we all had to just always have our eyes on Twitter back then. And here's the cycle, Ross, and tell me what you think about the cycle. So he would say something, again, making policy, making proposals. The market would react as markets do when new information appears, new assumptions, new expectations. The market reacts, maybe negatively, maybe positively. The market reacts. Then we kind of digest for a little bit. Everybody's like, oh, what did he say? What does that mean? Not only what does that mean, can it actually happen? Like, does he have the votes? Is this going to be, will this be a executive order? And then the market comes to grips with it. It kind of recovers and we start the cycle over. Ross, I saw this constantly.
Yeah, I think it's something that we need to internalize because the president-elect Trump does like to make policy in public, right? He negotiates in public. Social media is a tool that he uses unlike any president before him and most other politicians. So it's just a different style. I think that the traditional media has had a tough time getting used to it. And so the stuff that we see every day maybe feels noisier, feels more reactionary. But at the end of the day, again, we went through this cycle 100 times in 2017 and had the calmest year in market history. So I think this is one of those ones, you came up with this, so all credit to you, but I think it's one that all investors need to keep in their back pocket because if you don't have this as your mental framework, I think the next 4 years are going to feel really long. Yeah. Because this is just how it's going to be. And that's totally fine. It's just the way of the world and it's the way that a different president operates, but it's one to keep maybe framed on your wall.
Yeah, and I guess this goes back to a lot of the things I mentioned in live events or to clients. I mentioned what is said by whoever, Federal Reserve Chairman, the President of the United States, a CEO, what is said and what can actually happen? What does it actually mean? What we're trying to do with this image, this slide is just say, just because you hear something doesn't necessarily mean it's going to happen. That's just this new paradigm, this new world we live in. And a lot of this stuff is just kind of thrown out. This might happen, and then we kind of take some time to digest it. And the market will react. It will, because that's what it does. It takes in information, reacts, and then figures out what that means and moves on. We just want to emphasize that over the next 4 years, you're probably just going to see a lot of this cycle. A lot of this is what I'm thinking. The market digests it. We kind of figure out what it all means, and we will be here to help you in the cycle, right? We'll be here to put it into perspective for everybody. All right, so there's a couple things we want to focus on that have been on clients' minds, that have been questions we've been asked. The first one, we want to talk a little bit about immigration, but not immigration from a social perspective. That's not what we're trying to do here. We're trying to just tackle immigration from does it matter for the market, right? Does it matter for stocks? Does it matter for the labor force? And Ross, I'm going to just give a little perspective and then maybe you can comment on it. Our friends at Strategas commented on it this morning too, in an email. I went to the Department of Homeland Security's website to try to find out what kind of immigration, what kind of deportations have we had in history? I had no idea. I wanted to look it up and I found this chart. So it turns out the US, in effect, according to history, deports about 1 million immigrants per year. That's what we've done. This chart will show by president how many deportations we've had. But it's effectively about 1 million per year. So immigration will be like this kind of dominant narrative as we kind of start off. We're kind of watching the proposals and what that impact would be kind of on the labor force. But our friends from Strategas wanted to kind of focus on, kind of the beginning of these policies. And essentially what their view is, and I think is probably right, is we'll probably worry about stopping the flow of immigrants first, right? We'll probably worry about the flow. The border will probably be the first manifestation of this, the flow of immigrants. But Ross, does this matter for the stock market? We answered this and all that matters, but I liked your take on it.
Yeah, I think it can, right? So if you look at, and seeing this chart is great because if you look at like 2021 and 2022, you see a kind of a jump. And the dominant narrative then, as the market was starting to unwind around all the inflation, was we have a shortage of workers in our country. And when you have a shortage of workers, it allows the labor that's left to demand higher wages, right? If there's just not enough people, what options do you have as a small business or a medium-sized business but to pay up to keep labor? And what happens when you have to pay more for workers? Well, one, workers can spend more, so you got a positive in a consumer economy. But two, businesses usually pass on those expenses in the form of price inflation, right? So a big part of the inflationary spike in 2021 and 2022 was the shortage of labor. The way that immigration reform could impact the market is if you have a big spike in deportation, so you get back to a world where we have a lot of demand for stuff, for services, for goods. We have this booming economy. And if you have all this demand and not enough workers to produce it, houses, haircuts, whatever it might be, then you can see inflation spike, and then that trickles into what's the Federal Reserve doing, what are interest rates doing, and how does that impact stocks? So yes, if it's pursued to a certain extent, it can impact the stock market. But as you said, it's really hard to kind of formulate an investing strategy when we don't even know the policy yet. I mean, we kind of have to get there first, but that is to me the playbook.
And before we move on just to the next topic, I looked into the sectors. People ask what sectors might this impact. Immigration, the immigration stock market economy argument kind of revolves around construction. It revolves around agriculture. It revolves around consumer discretion, like retail, like restaurant, service. But again, this would manifest itself in inflation, right? If we had less workers, the unemployment rate in the United States is about 4.3, right, Ross? 4.2, 4.3. So it's already very historically low. So this would manifest itself in wages and inflation. We'll keep our eyes on this. But again, our partner strategists think mostly about the border, the flow to start, and kind of the deportation stuff is probably further down the line. Not likely until Congress, passes some funding through a bill to work on that issue. But we think it'll start probably with just like the border. But again, we'll be watching this for any market impact, and we'll definitely be keeping you up to date on all that matters. The next one is like tariffs, taxes. Is that inflationary? Is it not? What I've seen again from our partners to strategists is that we expect agencies to kind of study the positive impacts of tariffs. Like we expect that. That'll probably be the initial part of this. What do tariffs mean? They'll probably study that for a while. The biggest risk, Ross, in my view, is President-elect Trump has talked about some sort of like across the world tariff thing where you just tariff every single thing coming to the United States. I've seen that. I think it might have been a social media post. I think that would be like the shorter term risk, that there's some emergency powers, worldwide tariff. But again, just because somebody says something doesn't necessarily mean it'll matter. We don't know. But taxes, tariffs, that's also on our minds, Ross, right?
Yeah, absolutely. I would say two things. One, I made the chart on the screen, so I'll explain it quickly. We just wanted to look at, because I do think the big question is, are these things inflationary, right? Is the bond market and the rise in yields, is that pricing in some expectation of a second inflation wave because of Trump 2.0 policy? And look, during his first term, President Trump had three main pillars: cut taxes, raise tariffs, immigration reform. They are focusing on the same big three things this time. Maybe it looks a little different, but the bones of the policy proposals are not all that different. And so the question that then you have to ask is, was it inflationary the first time around? And the answer is a pretty definitive no. From 2017 to 2019, before COVID broke the world, inflation under President Trump averaged about 2%, which is right where the Fed wants it. In fact, the Federal Reserve was cutting interest rates at this, during this window because they were so unworried about inflation, or they were more worried about growth than inflation. So it's not to say that these policies can't be inflationary. As Mike said, there's risk, for a universal tariff or some extreme policy. But again, like, we take it back to bare bones. What do we try to do? Be evidence-based investors, look at history where we think it applies. And the nice thing about having a second-term President Trump is we've seen this before. We can at least look at what happened on the ground. Inflation wasn't a massive deal then. Doesn't mean it won't be going forward. There are other factors at play, of course, that matter to inflation. But I think this is a solid baseline to say maybe it's not the biggest worry on the horizon, or maybe we're over-indexing to some inflation worry about these policies.
And one last thing before we move on to kind of the tariffs, taxes, two last things, I guess. A lot of the tariffs that President Trump put in on China during his first first presidency, were never removed by the next administration. So the current administration, the Biden administration, never removed them. In fact, they actually added a few more on China to high-tech goods. So it's not like we're starting from zero here on tariffs. The Chinese tariffs never left. The President Biden and his administration never removed them. So the market, from my perspective, and probably most strategists' perspective, is that global one, the like, I'm putting a tariff on every single thing coming, like that, I think is one of the real, like, the market would have to come to grips with what that meant. And, you know, we just don't know whether that will be the case or not yet. And then taxes, obviously taxes will be part of the negotiations for the funding bills, for the border, and all these different bills. We have excellent tax experts at Baird. Tim Steffen's one of them. We have an entire department, excellent tax experts. So we have your back on whatever proposals, whatever changes. We have experts for you on that. We will be ready to deploy them at any moment once we kind of know what might happen. I mean, they're talking about the SALT taxes. They're talking about all the corporate taxes. We just don't know yet on that. They need to get into power, and then remember that their House majority is very slim. I mean, I think the House majority, they can't lose like any votes, or you know, these things that the administration want to pass may not pass, right? I think it's the slimmest House majority since the Great Depression. So it's like just a tiny, tiny amount. Let's move on. We're getting a little bogged down on this. Ross, I think your next slide was, what matters is the consumer. The consumer. Look at, so this little chart is just consumer spending, right, Ross?
Yeah, let's do these next two quickly, because I think they're the two things that we think probably matter the most, medium term and long term, to the market and the economy. And the consumer, to me, I mean, it shows it on the right. What is the percent of our economy that is consumer? It's 70%. 100 years ago, manufacturing might have been 70%. 200 years ago, it might have been agriculture. Today, we are a consumer services economy. And what matters? What matters is how wealthy people feel, how confident they feel in their job, and is that resulting in spending? The answer is they feel confident in the labor market, they feel generally confident about the economy, and they are spending. That's the line chart. They're spending leagues above how we were spending prior to COVID and all the stimulus. I threw some headlines in there. This stuff matters. I mean, the economy is just what you and I do every day with our dollars, right? And especially the US economy, which is consumer based. Mike and I were maybe a little bit tongue in cheek, maybe not, talking about Taylor Swift like a year ago and how important it was to the economy. It's not tongue in cheek. I mean, a $2 billion tour plus all of the hotel spending. I mean, it made its way into like Federal Reserve working papers. This stuff matters, how the consumer spends their dollars. And I think post-COVID, the consumer has kind of changed how they operate. They're spending more. They want services. They want to travel. They want to experience things. This stuff matters. This is not, to me, anecdotal. Anyway, all to say the consumer's in a good place. The labor market is pretty solid. And all of this is resulting in why we never hit the recession that was so widely forecast in 2023.
I think one of the best ways to think about the economy and then the stock market and the thing that you operate in, you as an individual, what is the average consumer doing? What is the average consumer doing? Is like, if you wake up and you wanted to ask yourself one really smart question, what's the average consumer doing? Are they buying things? Are they going on trips? What are they doing? That kind of should guide your very first question. Then, like, the average consumer isn't thinking about, the decline of the dollar, the demise of this stuff. They're just not. The average consumer is waking up, going to work, buying Starbucks, taking care of their kids, going home, having dinner. They're not thinking about things like central bank digital currencies. So consumer continues to remain very strong in the United States, and that keeps the stock market strong. So whatever can keep the consumer strong is what we like. Whatever might be a headwind to the consumer is what we would consider kind of a threat. So let's move on. One more, which this is one of my favorite. It's going to be a little noisy, but let me talk you through this. So it was a really cool chart that we found online about just why the US stock market is so great compared to the EU, compared to Europe. Okay. So these bubbles are companies started from zero that are less than 50 years old with at least a 10 billion market cap. And you'll see the US has so many bubbles. Look how many bubbles. Companies started from zero in the last 50 years that are greater than 10 billion market cap. Look at them all. And then look at the EU. Look at how many companies that they've created over that same time frame. Here's some more stats that I put on Twitter that I thought was great, Ross. In the last 50 years, the EU has only founded 3 companies with market caps greater than $100 billion right now. 3 in 50 years. The United States has 25. By the way, the 3 in Europe are AstraZeneca, which is a drug company, ASML, which is a semi company, and a textile company in Spain, which is Zara, pretty much the Zara brand. In the last 30 years, Europe has zero. Zero. The US has 14 companies greater than 100 billion market cap. We are essentially, and always have been, the most dynamic economy and entrepreneur environment in the history of the world. This is what you're invested in. You're invested in companies starting from zero and going to 100 billion plus. We dominate it. We absolutely dominate it. Right, Ross?
Yeah, I want to say two things on this. So number one, there's a chart that shows it's something called high propensity business applications, and it's the government's way of saying a business application with like a shot of being a real business. It's not like a 2 a.m. bar idea. These are real thought out. And what we saw was post GFC, it kind of plummets a bit, and it's flat for about 10 years. And then we have COVID, and you would think that would make it plummet even more. We have a recession, we have all this loss of income. Instead, that number jumps, and it has stayed about 50% higher than the pre-COVID level for the last 5 years. The entrepreneurial spirit in this country is unbelievable. And that's why today we have an NVIDIA when it was founded 30 years ago in a Denny's or whatever the story is.
Yep.
The next NVIDIA is being started in a garage today and will be on this chart if Mike and I are still lucky enough to be doing this in 30 years. And the other thing I would say is, we talk about a lot the worries about the concentration in the US stock market in the big tech names, right? Are we too top heavy? Or should we be worried about this concentration? I think it's a fair question to ask, but it also is a framing problem to me. We should also be saying, wow, look at these huge, massive companies with big moats that have some of the best human capital and smartest people in the world, innovating new products that we get to invest in. Shouldn't they be so big? Maybe this is a good thing, right? It's always framed as, hey, when is this a risk? When is it a problem? I don't want to say that's an invalid question, but the other thing I want to say is, wow, aren't we tremendously lucky to invest in the companies that are, changing the world and innovating in ways that, we just haven't seen before. And it shows up on this chart.
Yeah, these companies make a lot of money. There's no comparison between now and in the late 90s. These companies nowadays, their free cash flow is immense. Absolutely immense. They make so much money. NVIDIA just had an investor presentation, a product day, where they're showing giant chips that are going to create AI. Like these aren't fake companies. These are real companies. If you want to worry about concentration, it's something to talk about. But do you want these companies to be smaller? Do you want the big companies to be smaller? Look at all these bubbles that we created in the United States over the past 50 years. They all started from zero, and that's happening right now. We're just going to end on this chart, which is kind of you might see this very often in an advisor's office or at a client event, or just thinking about the long-term view, which is the blue mountains are bull markets, and the orange or red, whatever color that is, are bear markets. And if you look at this chart and say to yourself, I'm willing to tolerate those downs to get those ups, I think that's probably a great conclusion, because those ups are massive and they go on for long periods of time. The bear market in 2022 was just an average bear market. It fell 23%. It felt terrible along the way, but it was just an average bear market a couple of years ago. The United States of America creates an immense wealth, and it continues to create immense wealth. And I think it always will create immense wealth, even amongst all of your worries, even amongst all these things that go through your head every day that get put in there. What's your perspective on this, Ross? As you're younger than I am.
To me, it's kind of what you said. I don't have a ton to add. It looks to me, framing it like this is probably the best way you could put what an incredible wealth creation tool the stock market has been over the last 7,500 years. And I also think, we talk about, and I think we'll answer a question in the chat about whether, this market has run too far. And I get this question a lot is, should we take some chips off the table? Are we at the top? Look at the average bull market over the last, since World War II on this chart. And then look at the one we're in today. It's small.
Still small?
Just to get to the average bull market, there would be room to run. Now, there are plenty of bull markets that look a lot like the one we're in today, but it's just a math problem. The bull markets so outweigh the bears in terms of length and magnitude that, in my opinion, you're more likely to do damage trying to avoid the bear markets than just to weather the storm and have a plan that's built to get through those when they pop up. Because they will. Like you said, we'll probably have a bear market in the next administration. We get a recession about once every 6 or 7 years. these are the realities of investing, but so are the 10, 12-year bull markets that create more wealth than I could, most of us could imagine.
Yeah. Yeah. I mean, it's just the thing I think that knocks most people off of building their wealth. Okay. The thing you want to build more wealth. That's why you've engaged with us. You want us to help you navigate tricky waters, plan for your future, charitable giving, estate planning, all that stuff. The thing I think from my perspective, after being in this industry for 20 years and being a 51-year-old and seeing all sorts of crazy things, I think the thing that knocks most people out of wealth building is generated from inside themselves. I really do. I don't think it's generated from the world. I think it's generated from inside themselves. Somebody says something and then they hear something and then they just go to cash and then that's it. They just tend to knock themselves out of their plan. What I really, really want people to remember is that you will never in your entire life, from now until you die, never will anybody ever comes after you ever say, I'm happy with the way everything's going. I'm happy with politics. I'm happy with the world. I'm happy with the market. I'm happy with my data. You will never enter a version of the world where you're like, I'm so comfortable. Everything is exactly how I wanted it, and I'm all in on the stock market. That world doesn't exist. It just doesn't, and you should stop trying to seek it, right? The last 2 years have been incredible to grow wealth, incredible. And think about all the things that think about the things we talked about over the past few years. So, somebody asked, what's the left axis on the long-term chart? That's the percent, the cumulative percent of those bull markets. So 100%, 200%, 300%, 400%. That's the percent. You guys can have these slides. So I believe these slides will be available to you during the presentation. We are going to, that was 40 minutes, maybe 10 minutes longer than we thought. We're going to kick back to our friend Corbin as we kick the Q&A part off.
Yes, Mike, Ross, incredible job. Thanks for putting this together. I'll be real brief. We already have the Q&A chat filling up, but just in case you do have a question and you're curious where you can ask those, want to just take a moment, remind everyone that you can do so via the Q&A icon on the bottom right-hand side of your screen. So, and just please be sure to address your questions to all panelists so we can see those. But Mike, Ross, I know we have a number that have come in, so I'll kick back to you to maybe start with the first one.
Yeah. So there's a couple questions, Ross, about the LA fire. I'm going to read a couple of them, but I think they're mostly asking the same thing, right? So one of the questions is, what's the economic impact of the fire calamity in LA? It seems major. Tens of billions in losses accumulated. I wonder what effect on insurance companies, also lost productivity due to masses of people displaced from their homes, businesses destroyed, et cetera. And then I think the very first question we got was, does the California fire present challenges, perhaps opportunities for the market? So I looked up while you were talking, Ross, what the biggest natural disaster was in U.S. history, because they're starting to say that the LA fires could be something like 125 billion in costs. I looked up what the largest natural disasters in U.S. history. Everybody can probably guess what number one is. It actually happened, I don't know, was that 20 years ago? So Hurricane Katrina is listed as the number one worst natural disaster in United States history. The estimated fatalities about 1,400 people, and damages were estimated at about 125 billion for the city of New Orleans, which is roughly what they're talking about today. I mean, maybe inflation adjusted, it would be way more, right? This is 2005. That didn't affect the stock market. Let me remind you that there was no stock market impact of Hurricane Katrina. 2005 was 2005, 06, 07, right? Before the GFC. The stock market wasn't concerned about the impact there in terms of the stock market, right? The human impact is obviously immense. So I think Ross, in my opinion, and you can weigh in here, one of the things that people are going to have to grapple with is like, will insurance companies abandon certain areas of the country? I think that's a more important structural or societal question, because we've already seen insurers pull out of Florida and places where hurricanes keep touching down. Will more insurers pull out of places that they model risks for? Probably. So we're gonna have to deal with the fact that, if you can't insure your home, what does that do for population migration and demographics and stuff like that? But to answer this question, are there opportunities? I can't think of any stock market ramifications. I mean, there will be companies that will rebuild LA, like there are building products companies and stuff like that, but they face nationwide issues, not just LA issues. They face nationwide demand issues for their products. But I don't necessarily think that there's a market reaction from this event, Ross.
Yeah, I agree. Obviously, our hearts go out to all the people affected. I think that, like, the many hurricanes and other natural disasters that pop up, it can have a small impact on maybe what unemployment numbers look like or data collection. LA is obviously a very big market to the economy, but in context of the US economy and global economy, it's still just kind of a blip. So I would lean with you. I would say the one thing, and that this was great from our partners at Strategas. So the IRS delayed tax payments of individuals and businesses in LA County. So what that means is that we will have less tax revenue coming in at normal tax time. This is important because we're going to have a debt ceiling fight this year. And to the extent that there's less revenue to pay out once we hit that debt ceiling, it could pull forward the date where we quote unquote kind of run out of money. It's called the X date. So that's like pretty wonky. That's pretty in the weeds. But you might start to be hearing about that, especially if they widen the area or extend the time for tax collection. But I generally lean with you, Mike. I just thought I'd note that because our partners at Strategas, the policy team has been all over this. So you want to go to the next one? I think we were talking about the EU companies, and I saw one in here that asked about other countries, right? Obviously, we're kind of picking on the EU here. It said compare it to China. And I'll turn it over to you to see what you think about, the dynamism of other countries. I still think the US pretty much stands ahead. Obviously, the EU has had some idiosyncratic struggles, but our partners at Strategas, I'll give them another shout out. Our guy, Todd Sohn, has had a chart before that shows over the last 30 years, the Chinese stock market is functionally flat.
Nowhere. It's gone nowhere.
0%, maybe 1% now. They've had a nice little run, 1% a year over 30 years. So again, they have created more dynamic and tech-centric companies, but they have other issues that have kept those companies from ascending to the heights, and certainly the stock market gains that the U.S. companies have, primarily being that, the state has a lot more control over what goes on there.
It's the China thing is it's a Chinese communist, it's a communist nation, so it's centrally planned. Look at Baba, look at the stock Baba, which is, was put up as this like great Chinese company. Again, has gone nowhere. When these Chinese companies get big enough, they just seize them, right? It's a communist nation, centrally planned. So the entrepreneurial dynamism is so totally different than the United States. It's totally different. The United States is where all the best companies in the world are founded and created because we have this incredible dynamic workforce and technology and rule of law and economy. And that's why the U.S. stock market has done so well for so long. We're this just fantastic economic juggernaut. And speaking of economic juggernaut, there was a question down here, Ross, that I'm gonna work these in together. Somebody asked about consumer balance sheets, about debt, which we get a lot of debt questions. Oh yeah, showing the consumer confidence. Is there concern in the U.S. consumer with the landmark $1 trillion in credit card debt being eclipsed this year? And then there's a question about the national debt and deficit. So let's fold these in together. I want everybody on the call to remember the United States runs a credit-based economy. We're a credit-based economy, which means that there's a balance sheet, assets, liabilities, a balance sheet. What is the U.S. consumer's balance sheet? You mentioned the $1 trillion in credit card debt. I just pulled up from the Federal Reserve's website the last look at the financial balance sheets of household in the United States of America. We have 190 trillion in assets and 20 trillion in liabilities. The 20 trillion in liabilities is made up of that 1 trillion in credit card, but mostly mortgages and other kinds of debt. So 190 minus 20 is about 169 trillion in net worth. Net worth. So just take one minus the other. The United States' net worth in the third quarter of 2024 was at its all-time high. Net worth. So always ask yourself when you see a debt number, what's on the other side of the balance sheet? Like you have debt, right? You have debt. You have a mortgage. You have credit card debt. You have whatever debt. You have assets too, right? You have stock market, home. One minus the other is your net worth. So just because one number goes up, is the other number going up? Right? Is your net worth rising? Is it falling? Important to remember. And then the national debt budget deficit stuff, Ross, we did a video on that.
We did.
Right?
Yeah, you can seek that out. We cover it in great detail. It's probably the number one concern of our clients. If I had to put my finger on it, I would say two quick things. I would say one, the question frames it as nobody seems to be talking about it. I would argue that this administration, just in creating the Department of Government Efficiency, is at least thinking about it. We'll see how effective that will be, but as an endeavor, they're at least thinking about it. And then number two, in a lot of my live presentations, I show a screen grab of a magazine from like 1975. It's, I think, Business Week, and it says, "Is the U.S. going broke?" And it's talking about the national debt
Yeah.
and how big it is. And the stock market from 1975 to today is up some 30,000, 40,000%. I mean, just again, generational wealth being created. So it's not that we don't think about the debt and deficit. It can matter at times, especially to yields. But to today, to this very moment, it has not been a weight on wealth creation in the stock market or the bond market or other financial markets. So it's something that we keep back in mind, but I think that most people over-index to it because it's used as kind of a fear-mongering tool in the media, and just because the number is so big. I mean, it is a huge number. But again, to Mike's point, look at the assets, look at the income. The United States is doing just fine.
But the United States is the richest nation in the history of the world. You live in and belong to the wealthiest nation in the history of the planet. We're extremely wealthy. We have 36 trillion in debt, Social Security, unfunded liabilities. Yes. What are the assets of the United States? I wrote a blog called "What is the Balance Sheet of the United States?" Seek that out. I'll get your advisor to send it to you. You can read my take on what is our balance sheet, what are our assets, what are our liabilities, what is our net worth. Those are important to remember. Two more questions, and then we'll wrap this up. There are people asking about the presentation, what we're doing here. It's being recorded. You'll be able to watch as much as you want. The slides will be part of the presentation, so it is being recorded. There's questions about crypto in here. I do think that crypto is this one space that I think the new administration seems to be embracing more. They're putting a crypto czar in. They've talked more and more about regulation around crypto. Here at Baird, we try to be thoughtful about this stuff because we care about our investors. We care about protecting them. We care about what is essentially still kind of an unknown, unregulated type entity, right? So I think this new administration will probably embrace crypto more again. But we at Baird are trying to be super thoughtful about protecting you from any of these kind of pitfalls that can happen in this space. So stay tuned. But again, our whole thought here is just to make sure that our clients and advisors are educated on the topic, but also protected like investors in the United States should be from bad actors. So I think, Corbin, I don't see anything else in here that Ross.
Somebody asked what the GFC was. I just wanted, that's the Great Financial Crisis. Just to put a bow on it. Yeah, that's
the housing meltdown in 07 to 09, which was, by the way, one of the worst things to ever happen to our economy, ever. And that was, think of how far long ago that was. Let me just, before we kick it back to you, Corbin, I know there's lots of stuff on your mind. Ross and I exist, again, to help answer these questions. That's why we exist. We also exist to help you kind of understand the world in really digestible ways. Like, the whole point of me talking about the balance sheet is to help you understand that just because debt exists, assets also exist. We're trying to make this digestible, right? That's all of our content, all of our written, all of our verbal, all of our live events are for you to come and say, I love the way Baird and my advisor and their team think. I love the way that they educate me. I love the way that they bring me along in a complex world so I can understand when I go to bed at night, what affects my money? Like, is it the debt or is it the interest rates? Is it the fire in LA or is it the earnings of the S&P 500, right? That's why we exist, Ross. You want to say anything at the end here?
I think you put it really well. I would just say, thank you to all of the clients who tuned in, who trust Baird with your financial well-being. It's not something that we take lightly. And I know Mike and I, as well as all the advisors and other folks within Baird, spend all of our time thinking about ways to improve your financial well-being. So thank you so much for entrusting us with that responsibility.
All right, Corbin, we'll kick it back.
Yep, Mike, Ross, real quick. So you guys have your All That Matters series. Is that something folks here can subscribe to? You put out monthly content, and a lot of it is really timely and just good to kind of help keep the right perspective throughout the year. Yeah. So what's the best way for folks to stay in tune with that?
I'll speak for me then, Ross. So we do All That Matters once a month. There will be an episode out at the end of this week. You can sign up for my email list, so it will be delivered directly to your inbox. Or you can ask your advisor to send it to you when we produce it. Sometimes it's on their websites too. And then I write a blog called Bull and Baird, which I should have one out on perspectives here within the next few weeks. You can subscribe to that also. Ross, what about you?
Yeah, check out the Baird YouTube page. All That Matters goes there, as well as our weekly market strategy videos with our partners at Strategas. I write a weekly note called 5 for Friday and a monthly piece called In the Markets Now. If you want to take a look at any of those, request them from your advisor. They're available in a lot of different formats. So Yeah, absolutely. We're happy to help answer any questions that pop up afterwards as well. Be sure to reach out.
Awesome. Thanks, guys. Just to wrap up with some of our closing comments here. Just again, want to thank you both for your comments and candor today. Thank everyone on the line for your time today. Hope that you found this information impactful. If we were not able to address your question, as Mike and Ross mentioned, you want additional information, reach out to your Baird contact. They'll get you in touch with the appropriate resource. We mentioned this as well. If you want to share this with a friend, family member, colleague, it was recorded, will be made available in approximately a week from today. Talk to your Baird financial advisor for that. It's also on bairdwealth.com. Ross mentioned the YouTube page, Baird YouTube page. It's available there. For those of you who aren't currently working with a Baird advisor, if you're interested in having a conversation, you can find an advisor near you on bairdwealth.com via the Find a Financial Advisor button. There will be a link to access that page and the post-event survey here after this call as well, so you can find that link there. With that, thank you, everyone. Enjoy the rest of your afternoon and have a great 2025. Appreciate you.